You know, there's that song in the limbo dance, how low can you go? Well, it's the opposite for the market. How high can it go? That's kind of the operating question right now. There's a lot of debate as to how justified this is. There's a lot of macro things pointing to the fact that this is perfectly normal. There's a lot of technical factors that suggest that this is not perfectly normal. So I'm going to break all that down and how to reconcile the two from your perspective, because all that matters is, well, how do I trade it? That's what matters the most, and how do I manage my portfolio? So we'll break that down. We'll take a look at a trade that did not work out for us at all the last time we talked about this, but now is offering another opportunity, but this side to the other direction. So I'm going to show you how to make that trade, which allows for profit on a pullback. But then if it were to, if it continues to go in this bullish direction like everything else is, we're able to manage the risk there as well. So let's go ahead and get started. Today is Friday, January the 12th, 2018. This is the Market Outlook video from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found us for the first time. Hope you keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know a couple of things. First, that you like the video. Second, that you want me to do it again. Do another one here, in this case on Tuesday, the next trading day. So it's a one-click way for you to give me some feedback. Scroll down further and comment on anything that stands out to you from today's video. I love to see what you're getting out of these. You can also see in the description below, there's a lot of links there. I've highlighted the link to subscribe to our daily email newsletter from MarketScholars.com. Follow me on Twitter for more content in addition to these videos. You see my handle up there at DavidSettle42. Like and retweet tonight's Market Outlook tweet from there. We're shooting for 150 now. We've gotten over 100 a couple days in a row. So let's see if we can get it over 150. Also, remember to join the Market Outlook community on Facebook. You see the address at the screen. There's also a link down there in the description below. Click on that, and then when you get to that page, click on Join This Group. And join the almost 800 others of you that are following and watching these videos day by day so you can interact with us. Alright, let's take a look at the S&P 500, and you can see how the moves it's making, you're kind of running out of superlatives to describe this move, other than, it's making the bullish trade ideas we've talked about look really good, and the bearish ones, the few that we've done, like on Delta, just look really bad. Delta just taken off like a rocket. So, again, the importance of trading with the trend. And again, looking at bearish trades as smaller trades for balance, not to be too directionally counter trend, but just doing something to take away some bullishness when you got so much risk. The risk being all that space right here. Again, this is like a this tightrope, like you're walking a tightrope. That 8-day moving average, which you happen to be above that, and down here's the ground. And the further you get away from it, the more risk there is. Not that you can't keep going up, obviously, but that again, the further away, the further you stretch the rubber band, eventually, it pops back or breaks, one or the other. And so, either way, here after a day after the momentum line hit to an extreme, the near-term line pretty much gets there, 98.5. The intermediate line's over 97, so you really can't get much higher. And just about every technical indicator right now is about as high as it is. We'll take a look at some here in a minute. The market sentiment up above 85 again. It's not very often that you get any kind of movement above 80 on market sentiment. You can take a look. There's been some examples where you've had a move like right here, this move coming up, that big blast push. A lot of similarities to this move, except for the fact that we're now 5 months into this intermediate trend, or going on 5 months, versus that move started going on 4 months in. So a little 1 month longer move. But very similar. You had that big spike higher when you were already above 80. Every other time you get above 80, as you can see, there's not a lot of movement to the upside at all whatsoever. I mean, that one you could kind of say, but you can see by the time we cross down below 80, a lot of volatility at the beginning of 2014. Again, that's when QE3, the tapering announcement was made, and when we started to taper, when you tapered all the way through 14 and ended QE right there. And you can see, again, going back to 2013, right here, another opportunity where you cross above 80 and there was some kind of return, trending return while it was above 80. Still didn't, and that was also a time where the intermediate posture, you can see, was up for quite a while. So coming up off of a market sentiment low point below 50, you had 1, 2, 3, 4 plus months of the intermediate posture before you had a, what was that amount to, a 1 week pullback right there in April. Maybe a little more than 1 month. I brought the intermediate line down, but not market sentiment, and you had another push higher here to sharp highs. That was a pretty decent move. Again, QE3 related, right? Because this is when QE3 started. But you take a look at that move from low to high, from when the market sentiment hit its low point, eventually. And then we rallied up to the high point of market sentiment's peak, which is up here. And you can see, that was a 50%, the second number to the right up there in the top, a 50% annualized return over the course of, 188 days. So just over 6 months, just over 6 months there, 50% annualized return. That's a pretty decent move. So again, a lot of similarities to that kind of move we're getting right now. Let's zoom back out to just the 1 year period. So near-term line now obviously has been above 50 for, see, almost that day. 1, 2, 3, 4, 5, 6, 7, 8 days, almost 9, just a smidgen below it over here. So that's a pretty decent near-term run at the end of a at the maturing end, at least, of an intermediate rally with market sentiment high, short-term sentiments really spiking up high, setting up possibilities of clusters. Never quite got one on the S&P 500. Of course, you got a lot closer to them on the Dow. You got one yesterday, almost got one again today, but the momentum line dropped just a smidgen there, but the pattern looks exactly the same. I mean, you look at this chart and it's like, of course, if you take away the logarithm, it looks worse, but the logarithmic chart itself just looks so parabolic, and you can see how, you had this steady trend, and then the trend quickened its pace right there, and then now we've got, let me draw it for you if it'll let me here. So there's the slow original trend, right? And then you started to pick up the pace. That didn't work. Let's try it one more time. Pick up the pace right there. And then now you go from here to that high above the 6-week moving average. You can see how it's speeding up, and that does that. Trends speed up, and then that's when they end. Now, who knows? Might not, most likely won't be Monday or Tuesday. It could go on for a while here, so don't look at that as an immediate kind of bearish signal. But that's what trends do. They will accelerate to the upside before they run out of gas like that. At least good, long, significant trends. Of course, the NASDAQ composite, you can see doing something very similar. It's just now starting to really take off. You can see how it's been kind of steady. The highs have been steady off these lows, and then all of a sudden, whammo, to the upside. Again, avoiding a cluster for a second consecutive day because of the drop in the momentum line. And then finally, the Russell 2000, which has really had the week, with yesterday's move here. Again, avoiding a reversal zone and a little bit of a long upper shadow there. Nothing significant, too significant, not nearly as long as that one was, but still a little bit longer upper shadow. So something to keep an eye on. Looks like it hit and reversed off of that 1600 level. Regardless, the posture still strongly bullish. Long-term sentiment still strong, strongly bullish. Near-term sentiment strongly bullish. There's not a lot in the market forecast that would suggest that we're strongly bearish. Now, of course, obviously, all the trends are long and mature and long in the tooth, and that's a risk factor, but they're also strongly bullish. So, it's a theme that we've been repeating here. We follow the trend. We trade We trade what we see, but we account for those risk factors, not in making a lot of bearish trades. You can make some, and again, make them smaller than normal because you're going counter trend, you're adding some balance to an active trading portfolio. But the bullish portion of your active trading portfolio should be rocking and rolling right now. So you can see on this long-term chart, the year started off with a bang, 2 straight weeks of strong moves higher there. And again, well, no need to remind you how far up above the 50-day moving average we are, how far above the 200-day moving average we are. In fact, there's a great tweet out there, a great chart that I saw. The unfortunate part of this charting package here is it doesn't allow us to see on a percentage basis how far above. You can see on an absolute basis is obviously the highest ever. But of course the index is also at its highest ever, so it's kind of hard to say. Well, I guess in 2000 over here we really got to a peak. About 112 points, and we're at 111. But 112 points at what the index was at 1527. So if you look at it over here, 112 out of 1527, that's 7.3. Yeah, about 7.3 points. Now, if you look at the last numbers here, you can see we're at 111 and a half. But now we're divided by 2786. So 4%. So not nearly as high as we were back here. We had really come off the 200-day moving average. That was a lot of sharp moves. The S&P 500 rallied in a matter of that many weeks up to about 12% in 10 days, 2 weeks, 10-day period, 12%, annualized return of 7,000%. That was one of the sharpest rallies we've seen in that amount of time. And that's what brought the MACD up so high off of its 200-day moving average. And now you can see similar, in terms of an absolute basis, similar move, but about a little bit more than half of what that was. But you can compare it to some of these other peaks, and we're getting pretty high. I think off the Dow Jones, if I recall, it was like 10% off the 200-day moving average. So we're overextended. Needless to say, we're overextended. We're also very high up above like the 8-day moving average. Again, you can you're as long as you're above the 8-day moving average, you're about as bullish as you can get. And we've been above the 8-day moving average, except for that one day right there, for quite a while since this little intermediate rally started in mid-November. All 3 lines are rising. The gap between the 3 lines is as big as it's been. It's way up there. And the stochastics, the moving average for the stochastics is high. So, again, it's a strong trend. You follow the trend, but just know that you're probably a lot closer to the end of the trend, the intermediate trending move, because of course we can just come down and bounce up and get going again. But you're a lot closer to the end of the current intermediate rally than we are the beginning. At least you would expect. I mean, we're again almost 5 months in, going on 5 months in. There's these intermediate rallies don't last 11 months or 12 months. They typically last 1 to 3 months. So, like I said, we're more towards the end than we are the beginning. Doesn't mean that we can't follow the trend. It doesn't mean that we have to be really counter trend. It just means that we have to account for the risk factors. Trade smaller than what you normally do. Trade less aggressively bullish. But even then, a lot of these bullish ideas, as you can see over the past couple of weeks, have been working really well. But all that could be null and void if a week from now we're back down to 2,700. Right? Because a lot of those stocks will probably be down too. And now, we might be cheering ourselves here this week and last week. But if it reverses all the way down and takes out some new trades we've been making and turns them into some pretty big losses, then that's really going to suck. So you can see why we need to account for the risk factors, because the more it gets up like this, the more likely, not 100% likely, but the more likely you get something that will reverse it back to the downside, which will be very painful for anybody who got in the last couple of days on some really big moves or positions, because they missed out on all this, thinking that, it can't be going up for whatever reason. It shouldn't be doing that, and that's why I reiterate over and over again. Trade what you see, not what you think you should see. So higher high, higher low, high at the end of the day, low at the beginning of the day. Again, about as bullish of a candle as you can possibly get. Remember how we talked about how that was hardly a bearish candle, the one down day we got in this whole move, because of the fact that the low was early and the high, we were closer towards the high by the end. But you can also see, you know, we keep moving this 4-week range up here. It is now up at 278. And you look at the low point, which we haven't moved yet, down to 265. That's a wide range for the 4-week average. With the midpoint now coming in, you know, roughly about what? Let's see, 278. You know, you got about 14 points. So about 271 here is the midpoint. So as long as you're above 271, any kind of pullback is like whatever. Near-term pullback, opportunity for new bullish rally until you get into the lower half of the chart. Now, in a few days, you'll move this up to, you know, just under 267, or roughly 267. That's 11 points. And now we're looking at about, you know, 272 as the midpoint of the range, maybe a little bit higher. So then that's going to be the level that we're going to be watching for in any kind of near-term pullback. As long as it stays up here, fine. We're still in the intermediate rally. You break through that, now the intermediate trend is going to be in doubt. If it gets to the lower half of that 4-week range, and of course, usually you'll tighten up that 4-week range before you get any kind of breakout to the downside and a more significant intermediate rally, or drop, excuse me, intermediate pullback. You take a look at the range today. The volume, 90 million, is a lot of volume in a big range. That is not typical for a bullish move. You don't see volume in the upper half of the 52-week range when you're this bullish for this long. You don't see trading ranges up this high, 2 points. You know, when you go up, as you see all these other times, you go up, and as you get more mature, the ranges get smaller, the volume gets lighter because you run out of buyers. And so we're getting a lot of buyers right now. And where are these buyers coming from that weren't coming in here? Well, it's the people who missed all of this. So they're going to be the weakest hands out of all of them. So again, big volumes, big ranges, and you can see volatility is not dropping while we're rallying. You would think the volatility should be dropping like to 7 right now. But if you notice, you know, the last time that we rallied, the volatility rallied to 10 off of a low point was over this Christmas period, right before the Christmas time. And you can see right before that Christmas time here, whoops, not that chart. We'll take a look at this one. This is what brought the volatility up higher. So we're at the same levels now as what that move caused, and that was a kind of a slightly down to sideways move. And this is a sharply higher move that's still bringing volatility up right now. So you know, this is, and not just on an absolute basis, but also on a relative basis. You can see it's trending its way up to 83. You know, what's that volatility going to do if we actually do start to pull back? Usually you'll just keep getting even bigger and bigger moves than what we're getting right now. You know, and now if the pullback moves are smaller, like we saw there a couple days ago, if they're smaller like that, if they're in the upper half of the chart, no big deal. If they're big, you know, if they get bigger and we get to the lower half, we get below 272, 271. Now we're looking at that intermediate pullback that we haven't had for a few months. So that's kind of what we watch for. But until we see it, we just expect, you know, what I expect is that we'll start to run out of buyers. But with lacking a catalyst to sell, we'll just start getting smaller ranges. So we'll slow down, but it'll still have a slightly upward bias, smaller ranges, and smaller volume. Momentum, that peak in momentum, will start to grind its way towards 0 on the MACD. And we'll start to catch those moving averages. We'll start to catch up the price before things get too crazy, and that could be a few weeks for all we know. All right, let's talk about what's driving the price action today. And as we do that, again, a reminder for more content that you're following me on Twitter and that you like and retweet the Market Outlook tweets. Always pinned here to the top. You'll see it. You see it says pin tweet there. We hit the highest number we've ever had, 118 on the last video. So again, thank you very much for that. The goal is try to get to 150. So make sure you like and retweet that. Again, The benefit you get out of that is Twitter will keep pushing you all my tweets because they see that you're engaging with it. The benefit I get out of that is the more the engagement it gets, the more Twitter will push it out to all the followers that are following me and make sure that they're seeing that because it's an engaging tweet. So I appreciate everybody that's been liking and retweeting the last couple of days. It's been higher than I've ever seen. So thank you very much for that. We take a look here at the asset classes. Today was a bad day for the dollar. Even though rate hike expectations are back over 70% from March. And then you can see, in fact, if we take a look at the rate hike expectations chart, you can see it rallied for March. We take a look at June, which would be the 175-200. Give that a second to come up here. There we go. 175-200, you can see it rallied. It's up almost to 50%. Take a look at September for the 200, 225. It went up 25 to 28%. Then you look at December, which would be the 225, 250. It's still kind of flat, but all these, are looking like we're going to get more and more rate hikes all throughout the next year. GDP estimates, a lot of good economic data from inventories to retail sales were strong. CPI on the core level was strong, and not so much on the headline basis, but all of that leading to higher GDP estimates, strong economic indicators. A little bit of a pullback, but bounce back up today, back up to 70 on this economic surprise index, and leading to higher rate hike expectations, but not leading to a higher U.S. dollar, and that U.S. dollar just really having a bad go of it today, breaking down sharply below support to the downside. That's a big break. And if we take a look at the Euro-U.S. dollar currency pair, and let's go back a little bit on here and take a look at the long-term view of this chart. In fact, let's go back further. Let's go back 5 years. You can see this is a breakout move up above 120. That was a kind of a round number. We've been fiddling around with it here, busting up through it to 122. That's 200 pips. That's a big move on this leveraged currency spot contract. And you can see the next level of resistance that we have. Let's go back. Let's go out to 10 years. The next level of resistance that we have is going to be, that you can see why it was so important. 120, multiple touches on the downside for lows, and then busting through it there. Now coming back up above, the next layer of resistance is going to be right about this 128 level, 128.50. It's a long ways up, and of course, when the dollar is dropping sharply as it is, this is no surprise. Gold, crude oil, and international stocks. I mean, as much as U.S. stocks have had a great couple of weeks here, and if I go out even further, a great 4 weeks, including the holiday season, the Santa Claus rally. There we go. So up 4.5%. So as much has been made about this move, and even since the end of the year, international stocks have outperformed. They're not getting as much of the headlines, but they're outperforming the S&P 500. And for that matter, small cap index too. And the dollar's just really had a bad few days, declining, but yields are not declining. You can see bond prices have also been down the last little bit. And just looking at just this week, so we'll take a look at right there, those 5 days. Strong move higher in stocks. Internationals have lagged this week. The dollar was relatively okay. It was actually up until the last couple of days. Here's our last 2 days of move. Dollar down more than 1.25%, and there's your international stocks bouncing back up. Not as much as small caps, because remember, they're not as sensitive to currency changes as large caps are. And you can see bond prices are rallying a little bit, and outpacing a high yield, which that's not on a really bullish move. 1.5% in 1 day for the broad, or 2 days for the broad market, and high yield and treasuries outpacing high yield. That's not the most normal risk-on pattern. You can see gold also holding its own against crude oil. Again, not the most risk-on pattern that you see, but it's a weak dollar move. It's really, it kind of shows not just in the dollar, but in yields too. The struggle yields have to get above this 2.6% level, being pretty lofty themselves. You can see the bond market saying, looks like we're running out of gas, even if the stock market's not quite saying that yet itself. And who do we trust? Well, if we had to defer to one, it would always, stock market will always be irrational longer than the bond market can be. The bond market tends to be smarter because it's got bigger money players, a lot more money than the stock market, and so you can trust it when there's a divergence between what the bond market and the stock market do. It's just a matter of how long it takes for that divergence to work out, because the stock market can be irrational longer. The sector rotation shows us also it's been a really, really bad week for utilities and for real estate. Both of them down. I mean, the market's up, 1.75%. But you can see technology lagging too. So it's not just these safe havens. Consumer staples down 0.5%. Utilities down 2%. Real estate down 3%. But technology about half of the return that the broad market itself had. And that's a big component of the S&P 500. From a cap weighting standpoint, you can see materials lagging too. But again, the last couple of days has been a big decline in the dollar, and materials is back up, and so is energy. You can see here, consumer discretionary has had a good couple of days. Retail has had a good couple of days. You can see industrial is also benefiting from the weak dollar. There's your real estate. There's all your safe havens, all lagging behind, and financials lagging. With bond yields coming back down. So you can see the kind of move you get with the dollar breaking support, how we want to play that breakdown to the downside in the US dollar. So for our trade idea of the day, I want to take a look at a trade that we talked about before to the downside back here when it had this head and shoulders pattern, kind of double-headed monster, and we looked at the breakout there, 35 of other support. But you can see this one, started off great, broke through that support of 35, and then morning star candlestick pattern reversal, and then hit stop orders at that 50% was what we usually put for long calls, long puts in this case, long options, calls or puts. So this is one that did not work according to the price pattern. And again, that's why you position size and manage risk. But since then, it's really taken off. That weak dollar has really gave it some upside momentum and breaking out. And you can see there's the opportunity for this to keep going up to 45 even if this thing really takes off. There's risk, of course, right? Because it's, the market's just insanely overbought. But there's also risk, too, to a bullish trade. And for this particular stock, because you can see it's overbought on the RSI. And previous times it gets overbought in the RSI, it kind of runs out of gas there. We've broken above 39 before and came down to 35. And then you can see in July we got up there and came down for a little bit before rallying back up. So, and here we got up to resistance, came down, then broke through that resistance there, came down and retested it. And that's the trade we were looking at before. So it's like, okay, well, we know we can chase it. We had a bad trade here. We can chase it now to the upside in this resistance breakout. But can we make a trade that's bullish, but also kind of profits from any potential pullback like we get like this at the same time? So I want to show you a couple of things here. First, now I've got Blast All in here. I'm not going to enter all three of these trades. I'm gonna show you how I can put together two different trades into one. The first trade being a calendar, thinking, okay, well, if it pulls back, I want to have a way to profit from any kind of pullback here in this front month. So I'm going to buy a calendar, in this case at a 23 delta. And if I buy that calendar by selling the 38 in February and buying the March to cover the risk to the downside, then it's going to cost me 40 cents. So that's a cash trade. It's going to cost me 40 cents to make that trade. I need to have 40 bucks per contract. Then we say, okay, but we are bullish. Eventually, we think it's going to be above 38. Because, again, if it pulls back, it's going to pull back to this old resistance, hover around here, and then bounce, right? Something similar to the last time the RSI got this high. Even here, it got high, pulled back, and bounced a little bit before, things really, the dollar had a kind of a move. But we know the dollar's really breaking support, so we know there's a lot of upside here, potential. So after a pullback, how about we say, okay, well, for March then, we'll sell this 38 and buy the 36 for protection, a vertical bull put spread. So that's this one right here, selling the 38 put, buying the 36 put spread for a 45-cent credit. Almost that 30% return on risk. In this case, a little bit more than normal. We're above the 50 days of what we're looking for. Typically, it's 50 days. But this is a high probability strategy. It's even higher probability because this thing's taken off like a rocket through resistance. We're just worried about that pullback. So the calendar profits from a pullback, and you can see it on the Analyze tab. You know, we pay 40 bucks. The calendar here can make me 55 bucks, which I can then add. You know, if I get 45 bucks on the vertical spread and I make a good 55 bucks or whatever I end up making out of this, maybe I end up making, you know, like 30 bucks out of this or 25 bucks. Well, I'm going to add that on any pullback to the credit I get, right? Because, you know, I make a profit from it. It's two different trades. The first trade's a calendar and then it's the vertical. Well, if I make something from the calendar and I make something from the vertical in this credit, those two go together. So now it kind of makes this vertical spread, if I were to take a look at that one now, you can see it's a high probability strategy, and this is a longer expiration on the March 17th, excuse me. So you can see it's a high probability strategy. We'll throw that the line up break even. 72% odds of getting that 45. But remember, if I get like another 30 cents, it's almost like I'm getting 75 cents credit, right? And now you can see my break even has been pushed back even further because I've kind of lowered my cost basis and I made it even a higher probability strategy. So profit from the pullback, and then once it bounces, take the gains, whatever I get out of that calendar, and then let that vertical work its way out. And it's just got to stay above 38 for it to do that, and I get all that credit. So if you notice though, when I put these two together, and let's go back to what that was, 45 cents. If I put these two trades together here, the 38 put, the long 38 put from March, and the short 38 put from March cancel each other out. So what I end up with is a short February put at 38 and a long 36 put in March, which essentially is this trade up here. It's a diagonal spread, which you can see has, you know, because of the credit to the upside, I have no risk to the upside. So it's a really high probability strategy because I'm getting a credit, which is that $5 up here. Now, granted, commissions are going to bring that below zero, so it's not completely no risk. But you see how, you know, we kind of, you know, this thing can take off. If it never pulls back, it's okay. It can take off, and you know, it's not doing what I want. But at least, you know, that 45 cent credit that I made on the short put vertical offsets the $40 cost of the calendar. So I make money on that, and by combining the two into one trade, I save commissions, because now instead of two trades with 4 different contracts, I have one trade with 2 different contracts. So this is what's called a put calendar spread, a put diagonal spread. It's again 2 trades put together. The calendar first, looking for that pullback because of how high the RSI is, and then after it pulls back and bounces, taking off the calendar, whatever gains I get will be added to the credit I get from the vertical spread that's embedded in this diagonal, because there's that 38, 36 March. Once I roll the February 16 38 put to a March 16 38 put, now I have my vertical spread, and we saw that the credit was right around that 45 cents. So you know, that return I'll add to it by whatever I make from the calendar spread that we're starting off this trade with. So it's to kind of show you a way to make 2 trades in one, save commissions, but also have two different things we're looking for. First, looking for a pullback if we ever get that. We might not, but you can see from a Fibonacci standpoint, you know, as of right now, you can see where the Fibonacci retracement would get down to around that $38 level. So if we pull back down to there, great. Calendar spread works out. If we never pull back, great, because I make more from the vertical than I spent on the calendar. So either way, I'm okay. But if it pulls back, great. I make money in the calendar, roll it to turn it into the vertical spread as it bounces, and then away it goes and stays above 38, and the vertical spread works out. So to summarize, the market continues to be strongly bullish, to say the least. It's very overstretched. It doesn't necessarily mean we have to be bearish, but we do have to account for the risk. As little risk as there seems right now to be in the market, that's not the case, because we know there are big ranges during this rally. We've had big ranges this week. We've had a lot of volume today, and volatility has been rising. So this isn't a picture perfect rally. We're not breaking through a resistance. So there's a lot going on here where we really have stretched this rubber band, really stretched this rubber band now. So it's just a matter of when is it going to pop to the downside. That could be Tuesday. It could be next Tuesday or the following Tuesday. It could be a month from Tuesday, because, again, stock markets can stay irrational a lot longer than say, like the bond markets, for example. So, but we can't ignore the risks because of the stretched rubber band, and we account for those risks by putting on trades that are higher probability at a lower delta, like we saw today. With today's example, takes away my risk to the upside and takes advantage of any temporary pullback. So as always, remember to subscribe, like, and comment on the YouTube video right down below. Follow me on Twitter. Like and retweet today's Market Outlook tweet there. That helps make sure Twitter keeps pushing you the rest of my tweets. And then also remember to join the Market Outlook community on Facebook with the link down in the description below. Have a great holiday weekend, everybody. No video on Monday. We'll see you back on Tuesday. Have a great one, everyone. We'll see you next time.